Hey folks, so I'm going to show you how the higher the return, the shorter the amount of time it takes for your money to double, and that's a critical concept to understand in order to maximize your wealth. So, with that, looking at this table and chart I have, if you start with $1,000 and you're earning a 10% return, then over the years, we gave it 36 years, you only get $2,800 with it compounding. So you can see how this chart here, the red line, gradually increases and it eventually goes parabolic. But then you see your wealth has really gone parabolic in 36 years. So if we change this to a 5% return, and now I have to adjust this column. So now when you look at this, it's not as steep of a curve, it's just more gradual. So consequently, you can see how it's sharper with a 10% return. If we change it to a 15%, it's even steeper. But that's just a simple concept. We're going to go back to 10%. If you look at the $1,000 at 10%, it takes a little over 8 years in order to double your money. And to double, you mean 1,000 becomes 2,000, you double it again, it becomes 4,000, you double it again, it becomes 8,000, then 16, 32, 64, 128, 256, 512, etc. So consequently, you double it again, it's going to take about 16 years for that 2,000 to become 4,000, and then another 8 years, and you get, in about 23 years, you get 8,000, and then in about 31 years, you get 30 to 31, you get 16,000. So to double it, let's see, 1, 2, 4, 8, 16. So to double it 4 times, it took 30 years under a 10% return. Now, if you look at it with a 5% return versus 10%, you can see how gradual the 5% graph is, the 10% steeper. And if you were to add $1,000 a year, you can see how it's, it started out with a little hiccup because you started with 0 and added 1,000 on the first year. But it does the same thing. But look at this graph, 60,000 is where it goes up to, 53 in 36 years versus 28 when you don't add it. But you've put $36,000 down versus 1,000. Now, when it comes to stocks, if you invest in trusts, you have different trusts like REITs, business development trusts, energy trusts, and just going on your trading platform and using a stock screener, you can literally find the stocks with a positive EPS and a yield of 10% or more. They're going to have a high payout ratio, but they don't grow in value like other stocks where the stock price you buy it at 10 and in 10 years it's worth $100 a share. It's going to stay around $10 a share, but you've doubled your money with a higher percent yield in dividends. Now, if you were to do a swing trade, so here we said 36 years, let's change that to month. So then the first month you're earning 10% off a swing trade and everything. Then in 36 months, you're averaging $2,800 a month in revenue and you have a wealth of 28,000. So then you see in about 8 months, you've doubled your money doing these trades. And then in 16 months, you've quadrupled your money. So then 16 months is literally less than a year and a half. So as you can see, if you're doing some swing trades versus buying and holding, you can maximize the amount of yield in a short amount of time. Now, the one problem is it's riskier. But if you find a stock that has ups and downs and you find the patterns, And you can do 2 trades a month, let's say. Then you're literally doing this instead of 36 months, this is going to be 18 months. So then here, 8 months will be 4 months. Now, a lot of people like to day trade, and they look at the box and whisker plots, which under the business realm, they refer to them as candlesticks for some unknown reason. But in meteorology, we refer to them as box and whisker plots. It's literally, you're trying to be over analytical, looking at what it's going to do in the next minute or two. And it is tedious and a lot riskier, but if you're doing swing trades and you know the typical trading range of a stock over the several days, you can literally double your money in a short amount of time, even though it's not as short of amount of time as day trading, but it's a lot less risky. Well, I hope you found this video informative and helpful in ways you can double your money in a short amount of time, and how shortening the doubling interval will help lead to greater wealth. And this is important, especially if you're older in age and you're starting to invest, because just buying and holding at an older age means you have to put a lot more money down up front. But thanks for watching, and happy investing.